There was one student after class who asked me something that I thought might be worth repeating, which is the following. Remember that when you're talking about countries that are trying to fix their currencies to try and lower uncertainty, for example, and that sometimes countries are unable to do that because they've run out of reserves, right? If your currency is undervalued, then you're constantly buying foreign currency, and that means you're constantly expanding your money supply, which means that you'll eventually get inflation, which means you're not undervalued anymore. But the problem is if you're overvalued, then to keep it that way, you constantly have to deplete your currency reserves. That is again, remember, the central bank of this country needs to have among its assets a big stash of foreign currency that it uses to try and keep the exchange rate fixed. And if you run out, then you can no longer keep the currency overvalued and its value declines. The question with the student asked, which I thought was a good one, is when this happens, and the currency can't be kept fixed anymore and it devalues, does the currency take its fundamental value? Remember, there was some idea that even when the currency is fixed, there's some value that it would have if the market were left to its own devices based on things like inflation and so on. And the answer is that it might actually overshoot. In other words, suppose we're talking about the Argentinian peso and it's 1-to-1 with the dollar, and then suddenly it loses value. So, and let's say its fundamental value was something like 2 to the dollar. But when this happens, it might overshoot and go to 3 or 4, which is actually what happens. The question is, why might it overshoot? And this is again observing that while trying to fix currencies, the objective of that is supposedly to add stability, they may actually lead to increased instability under some circumstances. So to answer this question of why might it overshoot, consider the following thought experiment and think about what you would do. So suppose you're a businessman who deals in Argentina, or a businesswoman who deals in Argentina, or someone who lives there and otherwise has some financial interest in operations in Argentina. What would you do if you thought that the Central Bank of Argentina is about to run out of foreign currency reserves tomorrow? What should you do today? Sell, exactly. Get rid of your currency now and switch it for dollars before it's lost value. And of course, if you have some information, let's say you read in the newspaper that the currency is going to lose value tomorrow, probably you're not the only one. So everyone who was able to would be either selling their currency and buying dollars, or selling this peso short if there is a forward market for it. And of course, that means that it's, let's say its fundamental value, well, is something, but on top of it, now you have this extra force of people trying to dump the currency because they're afraid it's going to lose value. So when it finally, so that means that the central bank, of course, will run out of reserves even faster. And then when the exchange rate finally declines, they're probably going to overshoot, because on top of the fundamental factors that drive exchange rates, you also have the pressure of everyone trying to dump it before they get left with this worthless currency. So that situation, I thought I should tell you, is called a run on the currency. Okay, everyone just wants to dump it as soon as possible, and when people do that, the situation that they create makes matters even worse. All right, so I wanted to make sure that you've seen that first. Any questions or comments about this? So this then is the end of our discussion, so far at least, of foreign exchange. The next topic is quite different, and it starts the second part of this class, which I guess you could call the macro part of the course. Although at first it won't be obvious that we're doing anything especially macro. So if there are no questions, we can just leap right in and get started with that. And we can start with an observation that I made on the very first day of class, which was that there is a key distinction between two kinds of financial transactions. There are financial transactions that are direct, such as me buying bonds from the government or from corporations, or selling shares, where the lender and the borrower directly interact, as opposed to indirect financial markets. And in the case of indirect financial markets, between the borrower and the lender, there is some kind of intermediary, such as a bank. And on day one, you may remember that I mentioned that for the most part, financial markets tend to involve a lot of indirect finance. Certainly, if you or I ever wanted to borrow or lend, chances are there would be an intermediary involved. Yet, we're halfway through the semester, and we haven't talked about financial intermediaries yet. So, now is the time. Now is the time when we start to talk about financial intermediaries. Now, there are all sorts of financial intermediaries out there, and we did mention them at some point. We've come across the central bank, that's a financial intermediary. We'll talk about them later. I mentioned the clearinghouse in derivatives markets. Those are intermediaries. But again, the main kind of intermediary that we're going to talk about are banks, because they are very large players in financial markets, and again, they are also familiar to many of us, right? We interact with banks in various ways. If you use a debit card or a credit card, you're interacting with a bank. And then at some point later, we can discuss what differences there might be between the operation of banks and the operation of other financial intermediaries, if we have time. All right, so first we'll have a quick look at how it is that we can see what banks are doing. And then once we have an idea of, because of course what all banks are doing basically is helping borrowers and lenders meet. That's the business of indirect finance, right? And so we'll see how it is that they do this in practice, and then we can say more sensible things about the details of their operations. Okay? So to think about how banks work, I find it useful to imagine how banking might have actually started. So think back several hundred years. You might have to go quite a long way back if we want to go back to a time when there are no banks. So go back to a time, let's say, before paper money, before fiat money. So suppose that we live in a simple world where the money that we use is gold coins. And as I said, let's assume that there are no banks. It's easy if you try. All right, so you're living in a world where money is gold and there are no banks. And since in this world you went to GW, you're highly educated, and thus you become fantastically wealthy in this world. The problem is if you are wealthy in this world, that means, by definition, that you own a lot of gold, especially if you amassed your funds by doing business rather than just, say, by owning property. And you need to find some way to protect it. Now, that either means that you need to have a very seriously well-protected house, or, especially again, if you're a business person, you need to move around. So more likely than not, you might need to find someone who can look after it for you. Who could that be? Well, it might be someone who themselves has special facilities to look after precious metals. Let's say maybe a smith who actually works with metals, right? So then you find this person who has the correct facilities for looking after metals for you. Let's call this person Mr. Smith. And now, Mr. Smith, maybe you pay them a small fee and they look after your wealth for you. So Mr. Smith started off his business working with metals, but because of his facilities, it turns out he's a natural person to look after gold for other people. And so Mr. Smith now needs to keep a list, right? Because let's say Mr. Smith received, let's say, 5 pounds of gold from one client, let's say Lisa, and let's say 10 pounds of gold from Sophia, and let's say another 10 pounds of gold from Marshall. And of course, it all adds up to 25. So that's just the total. And on this list, he might call sources of gold, because that's what they are. That's who he ultimately owes this to. Now, what this person, Mr. Smith, may notice is that actually Lisa, Sophia, and Marshall don't show up very often to use their gold, right? Every now and then they might show up and use some of it, but much of the time the gold is just sitting there unused. There's actually an even better reason why Lisa, Sophia, and Marshall might not show up to get their gold here. That is the following. Presumably, all the clients of Mr. Smith have gone off with some sort of document or receipt that says, let's say, Lisa can have £5 of gold from Smith Bank. I'm just going to call it a bank now. What if instead of this kind of receipt that states who it is that the gold belongs to, what if instead this were somehow securitized? So instead of saying an individual person, instead it says whoever owns this document, or to give it another term, the bearer. If instead of having an account like this, you had a receipt that says the bearer, then this piece of paper, this document, could itself be used as money, right? And then all these clients would have even less reason to ever come to the bank and get some gold. What's the point? The point is Mr. Smith has all this gold sitting around. He charges fees from his clients to look after it, but he could make profits in a different way, which would be by lending out some of this gold. Can't lend out all of it, right? Because every now and then one of the clients might show up to take out some gold. Let's say he lends out a certain amount, and the rest he keeps just in case he needs it. This pile of gold that he keeps just in case he needs it is going to be called reserves. So it's going to sound like currency reserves, but it's a different thing. This is just cash that you're holding onto in case you need it. Or I guess gold, rather. And then this would be a second list now. This would be, you could call it uses of gold. So this is where the gold came from and who he owes it to. This is what he did with it. And of course, the total here has to be the same, right? Why does it have to be the same? Well, there's only one pile of gold. Each unit of gold came from somewhere and is either there or was lent out. So each piece of gold has two aspects. But and these two lists keep track of those two aspects. Where did it come from and where is it right now? But since there is only one pile, the total has to be the same on both sides. Okay? So what we just drew here is the balance sheet of Smith Bank. And this was a very simple example because, again, there are only a few items here. There's these accounts, or this gold that Mr. Smith is looking after is also going to have a name. These are your deposits. And then they're either as loans or as reserves. But the way banking works nowadays is going to bear some similarity to this. The main source of funds for banks is going to be your deposits. There'll be a few other sources of, well, we're not going to be calling them sources of gold, we're going to be calling them something else. But the main source is deposits. There are a few other items that are also going to be on this list of where the bank raises funds that we're going to look at. And on this side is even more similar, I guess. It'll similarly have loans, other assets that the bank might have purchased, and then there'll always be some reserves there. And the simple example will often have enough common sense in it for us to understand what's happening in banking today. Before that, I guess what I should do is tell you what the proper names for these things are. this list here, the sources of gold, or more generally sources of funds, are going to be called liabilities, because the bank is liable for them. They owe it to someone. They owe it to the clients, in this case. And this side, what did the bank do with the gold? In what form is it? This is known as assets. Okay. So now we have the terminology and hopefully a first pass at intuition for understanding what balance sheets look at nowadays. Any questions or comments? Sorry, any questions or comments regarding this first pass? Okay. Someone has a comment. Just a second, let me save this. Yes, Marshall, can you briefly go over securitization again? This was just in this case, this was just a story of how it is that paper money came into circulation. So securitization in general is the idea that you start with an asset, which is a private contract between two people. Let's say, in this case, Lisa opened an account here and, well, got a receipt. Oops, what's going on here? Sorry. But instead of having this private contracts, if the legal system allowed you to just have a contract that says, that has no name on it, whoever owns this is entitled to gold, then this document itself can be bought and sold or exchanged. In the case of bonds, it was similar. Imagine there's a loan between you and me, where it says that I will pay Marshall 10 pounds of gold in 1 year. What if we erased the Marshall and I just said, I will pay whoever owns this bond 10 pounds of gold next year? And then that person might initially have been Marshall, but then later on you might decide, you know, I need the money sooner. I'll see if I can find someone to buy this contract from me. Then you get to sell it, get the money sooner. And from my perspective, well, instead of paying you, I'm paying some other person, but what do I care? I'm still paying the same amount to whoever it is. So that's the idea of securitization. It just makes a contract that was a private contract between two people, instead it becomes a contract that's easy to resell, instead of waiting for the end of the contract. Okay? Great. All right, so the next logical step is to look at a contemporary balance sheet. So it's a double list. And on the right, we have liabilities, which in the other picture was sources of gold. We can think of it as sources of funds. That way it doesn't matter whether it's gold, dollars, renminbi, or anything else. Just call it funds. And on the left we had assets. And this is uses of funds. I think someone raised their hand. Yes, Sophia?
I have a question. I know you mentioned earlier like deposits as a source of funds, but I know some banks you can open like a safety deposit box and like you can put stuff in there. Would that be considered like sources of funds as well, or is that something different?
I guess in principle, since if they're looking after anything, they have to keep it there. Would they call it a deposit? I think they'd still call it a deposit, but it's a very small part of their business nowadays.
So would it show up on like a balance sheet, or is that part of something else?
I guess it would. I guess it would, although they wouldn't be able to use it for any purposes, right? But I think it would show up somewhere, just be a very small item. Let's come back to that example in a second, because so the bank has a pile of funds that it's dealing with. Each individual item came from somewhere and has to be in some form. So let's first populate this list, and then we can hopefully figure out where any given item fits on the two sides. If it's something like a gold watch that they're looking after for you, I think it would show up as deposits because they're looking after it for someone. But since they can't lend your watch out to someone else, at least I suppose they can't, that it would be in reserves as well on this side. That's how I think it would be. So let's go systematically, first with liabilities and then with assets. So I mentioned that the most important source of liabilities for banks nowadays is deposits, whether it's in a safety deposit box or more likely in a checking account, a savings account, a CD, or a money market fund. Those are all deposits, accounts that you open with the bank and you give them money and then they look after it for you. But as I mentioned, it's not the only liabilities that we're going to be interested in discussing. So if you needed money, if you needed funds for some reason, where would you get it from? Or where might you get it from if you need funds right now and you don't have any? Well, that's what the whole class is about, right? The whole class is about, or actually half the class is about people who need money and don't have it. And the other half is the ones that have it and don't need it right now. So the answer, of course, is that you might borrow. So banks may borrow too. And I'm going to write a smaller number there. But the way banks borrow and the reasons banks borrow are going to be a little different. We'll get to that soon. It turns out that most of the bank borrowings are overnight loans. Why would you lend only overnight? Well, we'll see in a bit. So one source of borrowings is other banks. So it turns out that other banks are lending to each other constantly, borrowing and lending from each other and to each other all the time. Those loans, in general, are known as, how original, interbank loans. In the United States, however, they have a special name, and you'll need to know it because if you read anything in the news or elsewhere in the economics literature about this, it's going to surely come up with that name, and the textbook, mind you. Loans between banks are known as federal funds loans, and the interest rates they charge each other is the federal funds rate. Okay? It can be confusing because these are deals between banks, right? The Fed isn't there, at least not directly, but they're still called federal funds loans, right? The other source from which banks can borrow, the other entity that lends to banks is the central bank itself, the Fed. Loans from the central bank are called official loans, but again, in the United States, they have a special nickname. In the United States, they're known as discount loans. And you might wonder, well, there is this interbank market, the federal funds market, where banks borrow and lend to each other all the time. Why do we need the central bank to be there, also lending to them? Well, the reason is, what if something happens that means that all the banks want to borrow at the same time? Right. If all the banks want to borrow at the same time, there's only limited funds that they could, no one wants to lend to the others. So presumably the federal funds rate would shoot sky high, and or they would simply not be able to borrow anything since no one is willing to lend to them. Sorry. So, of course, that might only happen in an emergency situation of some kind, but emergencies happen, as we've found out, unfortunately. And so the reason central banks were created in the first place was so they could be lenders of last resort. So when no one else wants to lend, you can keep financial markets stable by lending when others won't. I can give you an example of an emergency when the central bank lent money to everyone at the same. So when everyone wanted to borrow at the same time, all the banks wanted to borrow at the same time, nobody wanted to lend, and so the Fed stepped in. And that's on 9/11. 9/11, 2001. I had just moved to DC, like literally less than a week earlier. Superb timing. And I'm sure you know what happened on that day. One of the great tragedies of that day was that the World Trade Center collapsed. Now, it so happens that there was, and still is, a computer system called Fedwire. And the Fedwire system makes sure that banks can keep track of all the funds that are coming in or going out. So, for example, suppose you write a check to someone who is who has a different bank from you. When that check shows up at the other bank, it's going to take some time to clear, but immediately the signal that the check has showed up goes into Fedwire, so the bank knows, aha, someone wrote a check, the $100 are going to flow out of these accounts, and the other bank knows, aha, someone just brought a check, I know $100 are going to come in. They have to do the clearing process and so on. The check might bounce, but again, at least they have some advance warning. And this way they have an idea of how much liquidity they need at any moment, because they have a sense of how much money is about to go up. They're going to have to send out, which means they know how much to have as reserves. Now, what happened on 9/11? Among other things, it turns out that the computers that run the Fedwire system were located in the World Trade Center. So when the World Trade Center came down, one of the things that happened was that Fedwire came down. And suddenly the banks didn't have a good idea of how much reserves they needed, because they couldn't suddenly see who's writing what checks. And also people were panicking, taking money out of ATM machines, and I went to Safeway and all the water was gone. People panicked. So the banks see people are panicking. They also, thanks to Fedwire, can't see, driving blind basically. They can't see how much reserves they need. So what will you do if you're one of these banks? You would want to boost your reserves. How can you boost your reserves quickly? By borrowing. But all the banks are trying to do this at once. So what happened? The Fed stepped in. And the chairman of the Fed at the time, the chairperson of the Fed at the time was Alan Greenspan. He came on the radio. There was something called a radio back then. And made a statement. I think the word was the Federal Reserve. It said the discount window stands open and the Federal Reserve is ready to provide liquidity to anyone who needs it. So all the other government offices were shut down and cleared out because it wasn't clear if any other buildings beyond the Pentagon were going to be targeted. But the Fed stayed open and made this clear statement with, well, I don't know how clear it is, but the discount window is open and the Fed will provide liquidity to anyone who needs it means we are willing to lend money, make discount loans, that's the discount window, to anyone who needs it because, again, the banks are trying to pump up their reserves. What happened next? The Fed made, I forget how much money it was, but it was very large compared to, banks back then used to have a fairly stable amount of reserves, and then suddenly on that day it shot up by quite a bit. I think by 20% maybe, possibly. And then 4 days later or something, FedWire got up and running out of a different computer server somewhere else. And immediately all those loans were paid off and the financial system kept going as normal. So that's an example of the Fed acting as a lender of last resort. If all the banks the banks can usually take care of themselves, but there are crisis situations where the banks all are trying to borrow at once, and then the Fed steps in. Any questions or comments about borrowings? All right. There's one more item of liabilities that I want to underline, which does a Fed ever reject a loan from a bank? That's a good question. If the Fed is, if you need a loan from the Fed, chances are, so if you're lending to the Fed is going to want to look and see what you're like. So in a crisis situation like this, no, the Fed is going to lend to everyone, right? It's trying to make sure that the banks are able to operate smoothly. If it's not in normal times, sorry, if it's not in a crisis time, then the Fed might think it's rather unusual if you're coming knocking for a discount loan. Because it would suggest that for some reason the other banks aren't willing to lend to you. So I don't know if they would reject it, but they'd certainly want to know what's going on. Okay, we can come back to that in a bit once we've finished populating these two lists. There's one more item here. I'm going to say that it's smaller than the deposits as well, but it's going to be very, very, very important, though we probably won't get to why it's so important, so critical today. And it's the following. Remember that the bank is a business, just like any other. And businesses need to finance themselves by taking loans, for example. But another way in which businesses may finance themselves, and this is especially going to be the case when they're starting out, is with money that belongs to the owner of the business. That's true if you're a flower shop or a coffee shop or a bank. So money that belongs to the owners of the business is called bank capital. All banks have some, all companies have some, and as we'll see, if they don't have any, they will go bust. Exactly why, we'll have to see. I was about to say next week, but someone pointed out that next week is spring break, so I guess it'll have to be after that. So try and remember your bank balance sheets by then. These are funds that belong to the owners. Okay. Who owns banks? It varies. A bank, just like another business, could just be owned by a wealthy individual, and that's true in many countries. Or they may be owned by the government. That's also true in some countries. In the United States, in the UK, the banks are just businesses like any other one that raises funds by selling shares, and so then the bank capital is the value of the shares. Because then, who are the owners of a bank? The shareholders. But either way, whether it's a privately owned bank or whether it's owned by a large group of shareholders, the bank capital is just the funds that correspond to the owners. All right? One way to think about it is, if you imagine you had all these assets over here that we haven't looked at yet. If you added up all their value, what are you going to get? Well, you actually know what that is because the two sides of this balance sheet have to balance. Total here is 120. If you sold off all the assets, you would get 120, and then you pay off all the depositors and you pay off all the borrowings. What's left? 10. It's the bank capital. It is literally what is in some sense left over for the owners once you've taken care of all the other things that the, I guess, liabilities and obligations the bank has. So much for the assets. Sorry, liabilities. What about the assets? Well, in the ancient bank that we had the bank, the Mr. Smith bank, basically could make loans or keep the funds for safekeeping, right? And that's going to be more or less the same here. The bank can make some loans. Let's give it a number. Let's just say 60. But of course, there's another way in which the bank can hold its assets. Rather than making loans, it could just buy bonds from the market or shares or anything else. We're just going to call those things all securities. It's going to be mainly bonds, but and then whatever's left over are still reserves. Notice I made the reserves a lot smaller, but this is the equivalent of Mr. Smith, right, who takes in deposits of gold from various people, keeps some of it there just in case, and the rest is lent out in one form or another. And again, these two numbers, the two totals, have to be the same because the bank only has one pile of funds. Each dollar came from somewhere and is in some form currently. It's still just one pile. Is it correct to say the bank capital is included in the reserves? No, because it's just, it's just one source of funds. The total funds that they have to play with is 120, and it just happens that 10 of those correspond to them. The bank capital, all of these funds are in all these three forms. In general, you can't say that, let's say, we use the bank capital to only buy securities or something like that. It's just, again, it's just part of the total funds that the bank is controlling. We'll spend some time talking about bank capital when we come back. So again, one way of thinking about bank capital as well is it must be what the bank is worth in some sense, because again, if you sold off all these assets and paid off the depositors and the borrowings, what's left over, this number, is what's left over for whoever owns the bank. All right. So I was saying you need to keep some reserves in case the clients show up and want to. Actually, there's several things you could do with your reserves, right? Your reserves are there in case depositors show up and want to withdraw funds by writing checks or from ATMs. The Fed has to pay for those out of its reserves, right? It also needs reserves to pay off these loans, right? When the Fed borrows, or sorry, when the bank borrows, it has to pay that loan back. If it is going to pay and loan back, it needs to have some cash on hand, which means it must have some reserves. And I guess if the bank decides that it wants to pay any dividends, it would probably have to have, to the owners of the bank here, they probably also need to have some reserves as well. So conversely, what do you think might happen if the bank didn't have reserves? Or what if this reserve number were very small? Or to put another way, suppose you found out that your bank has really, really few reserves, not nearly enough to cover the deposits. Well, we know it has less, but imagine this number were even smaller. You might worry that your bank isn't going to have the funds to give you when you need it. So if you think that your bank is going to run out of funds tomorrow, let's say, what should you do today? Any ideas? You run to the bank today and get out your funds before they run out. And if for some reason lots of people share this belief, they'll all show up and the bank will in fact run out of funds. So that situation, as you described it in the chat, is indeed known as a bank run. And it could happen just as on the basis of a rumor, right? What if there's a rumor that Sandy Spring Bank is about to run out of funds? Then to be on the safe side, you might run to the bank to try and close your account and find that everyone else has done it as well. There are also more serious situations where bank runs might occur. Again, I think we'll need to wait until the following week to go into them. For now, we just need to know what they are. So, since bank runs are not good for financial stability, obviously, people running to the banks unable to get out their funds, the government has an interest in trying to avoid them. And so it turns out that there are several policies in place to try and make bank runs less likely. So in this example, the fear of the people was that the bank didn't have enough reserves. So one way of trying to avoid bank runs might be to institute some minimum amount of reserves that the bank has to have. Let's say a rule that says the bank must have at least 10% of its deposits in the form of reserves. Is this bank satisfying its reserve requirement? Yes, 10% of 100 is 10, and that's exactly what it has in reserves. Any more would be fine. Any less would run afoul of this reserve requirement, which the banks must satisfy every day. At the end of every day, they have to show their balance sheets to the Fed or to the regulator. And the idea of the reserve requirements is precisely that. Now, what happens if you're reaching the end of the day and you don't have enough reserves? What could you do? Exactly. There are several things you could do to get funds at short notice, but as both of you just said, Sophia and Marshall, you could run out and borrow more. So now I have, let's say, 11 there. This isn't balancing, but I could add up an extra amount there to meet my reserve requirement by going out and borrowing from other banks. Instead, I'm a bank that has a bit too much. Well, I guess a key thing to point out here for this question is before 2008, any funds that you had in reserves are just not earning you any money, right? The securities pay you interest, the loans pay you interest, the reserves didn't pay you anything. So if you have too many reserves, you would want to do the opposite of what the other bank did. Run over here and make Fed funds loans to other banks. So before 2008, that's the way banking worked. You had this required reserve ratio, and this Fed funds loan market was where banks would top up their reserves or lend out, at least for some profits, any extra or rather X reserves that they might have. Indeed, why did I say before 2008? It's because starting in 2008, the Fed began to pay interest on reserves. So now having reserves isn't costly in the opportunity cost kind of sense. And so since then, the required reserve ratio has been redundant. the banks have a lot more reserves than their required reserve ratio. But anyway, that used to be there, the required reserve ratio. It still is there. Not all countries have it. Does that mean that in countries that don't have a required reserve ratio, there are no reserves? No. It just means that the banks decide for themselves how much reserves to have. Now, there's another policy that there is in the United States that tries to deal with the possibility of bank runs. Any ideas? Every time you open an account, exactly, deposit insurance. Every time you open an account, the bank has to show you documentation that says whether the account you're opening has deposit insurance or does not have deposit insurance. So specifically what it'll say is this account insured by the FDIC or not? So Sophia pointed out that in the United States, not everywhere there is deposit insurance. And the agency that gives it out is the FDIC, where D and I stands for deposit insurance, the Federal Deposit Insurance Corporation. I misspelled insurance too. So that seems like a good idea, right? There can't be bank runs if the people's deposits are insured. If something goes wrong with the bank, they're not going to suffer, and so no bank runs. Well, not so fast. Anytime you see the word insurance, two words should leap to mind. And those two words are moral hazards. Exactly. So anytime someone is insured, there's the risk of moral hazard. So let's look for where the risk might be. First, we start by seeing who are the insured people here. Are the banks insured? No, the deposits are insured. We are insured. What that means is that no matter where we put our money, it's insured. We're not going to lose it. What does that mean? It means we don't care necessarily what the banks are doing over here. Imagine two banks. One bank is a very boring bank that invests only in super safe securities and loans, is very careful with your money. They can offer you, of course, a low interest rate because they're doing very, very safe stuff, but they're not going to go bust. Right? Now imagine a second bank. They're going to take all your money and go to Las Vegas and put all your money on the roulette table. They're going to gamble with it. If they win big, right? If they lose, it's your money, not theirs. And you wouldn't care either because your money is insured. So that reckless bank could actually offer you a high interest rate, knowing that if everything works out, they will actually be able to pay you the high interest rate. If things don't work out, you don't care because you're insured by the FDIC. So the risk is that in a world of deposit insurance, bank customers like you and me would gravitate towards banks that are not being run very responsibly, or risky banks, let's say. And so while deposit insurance is supposed to make the banking system more stable, it may actually make it less stable because of moral hazard. that means that people don't care if the banks are well run, and so banks that are badly run, or maybe they're well run but they're very risky, end up getting more customers. So there was a research paper a few years ago that I saw written by some top researchers. Let's see, one's at the World Bank and one's at the IMF, which is called, here it is, Does Deposit Insurance Increase Banking System Stability? An Empirical Investigation. What is the abstract saying? Based on evidence for 61 countries over 17 years, so this is papers from 2002, but anyway, they have a lot of countries and a lot of data. This study finds that deposit insurance tends to increase the likelihood of banking crises. Oh dear. They go on. More so where bank interest rates are deregulated. Right? Remember, a key mechanism here was that the bad banks need to be able to attract customers, and it's easier for them to do that, of course, if there's no regulation of the interest rates. And the institutional environment is weak. What does that mean? It means that the government regulation is weak, more generally. Also, blah, 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 the adverse impact of deposit insurance tends to be on bank stability, tends to be stronger the more extensive the coverage offered. In other words, the better the deposit insurance, the worse this problem becomes. Which makes sense. So, again, whenever you see the word insurance, you can immediately start thinking, where's the moral hazard? And after a few steps of common sense, you'll probably find it. And in this case, what's kind of cool, unfortunately, is that research suggests that indeed this moral hazard problem is there, and so deposit insurance actually doesn't help. You might think the third, what if all of this had to do with the banks not being regulated, or rather the banks being able to do risky things, right? So what if instead there's just a lot of oversight? So as discussed, the banks have to show their balance sheets every day to the Fed or to the regulator, so they can see if they're up to anything fishy. The problem is this. Suppose that, for example, it used to be the case before 2008 also that banks couldn't, well, no, a bit older than that, banks were not allowed to have shares in their securities. Okay? Because they're risky, riskier than most bonds. What if instead we did the following? I own this bank. I'm one of the owners of this bank, let's say. And I also go and I start out a company called Samaniego Financial Services Incorporated. I'm also a financial company, and what I do is I borrow money and I use it to buy shares. Actually, I didn't just borrow money from anyone. I borrowed money from this bank. How does this show up on the bank balance sheet? It shows up as a business loan, right? But in reality, it's a business loan to a company, the sole purpose of which is to buy shares. So the problem, this is the problem with oversight, that the banks can use creative accounting tools to try and engage in off-balance sheet activities, in activities where you can't necessarily easily see what they're actually up to. There's sort of a constant cat and mouse game between the regulators and the banks. The banks want to do risky things because risky things earn you more money. The regulators want them to be engaged in only safe things because they don't want to have banking crises. And I guess the bottom line is this will always go on, and the banking system will always have an undercurrent of instability that bursts into view every now and then when there's a financial crisis. Any questions, comments, thoughts about all of this? About bank balance sheets? This is our first pass at bank balance sheets. We'll come back to this after the break. In particular, one thing that we'll want to look at is the fact that aside from the regulations we've discussed, reserve requirements, deposit insurance, the fact that the Fed is here as a lender of last resort, we'll see later that the Fed also has some control over the Fed funds markets, the fact that there's Fed oversight, I guess the fact that many of these securities are government bonds, so the government is all over the place in here, right? In addition, we'll see that there are minimum requirements on capital. Why that is the case is going to take longer than 12 minutes to discuss, so we'll have to wait until we come back. But there's regulation everywhere in here. That's another important point out of here. So we've looked at bank balance sheets. They're kind of a window into everything that the banks are up to. And when we do that, we become familiar with their operations, which are to try and make profits, but they also have to do so while managing their liquidity, keeping their reserves. There are all sorts of ways to do it, right? Like one way we looked at, remember, was that if you were running out of reserves or you wanted to top up your reserves, you could just borrow from another bank. And of course, that means the total is up to 21. In the instance in which you borrow, you have this extra reserves there. It turns out that isn't the only way in which this firm might be able to increase its reserves. They're constantly doing all of these things all the time. Another way in which you might want to increase reserves would be by just selling securities, right? If you did that, notice nothing happens to the total amount of funds that you're engaging, that you're managing. You just sold the securities and then someone paid you cash, and cash is reserves. But in any case, that's the bank operation, to constantly try and manage their reserves in all these various ways to make sure they have enough, while at the same time trying to make profits. There's a bit of tension between the two, which is one reason why there's a lot of regulation. The fact that now interest is paid on reserves means that that tension is not as strong as it used to be, I guess. Okay. Any questions, comments? If not, then I think now would be, I think we have just enough time for our traditional 3, 2, 1. Let's go. All right. True or false? To the central bank, foreign currency is an asset. Is it true or is it false? Most of you got that right. Very good. TJ is ahead. True or false? Are bank borrowings an asset of the bank? It is false indeed. They are a liability. Next question. The main source of liabilities for banks is what? Deposits, loans, bonds, or borrowings? Deposits. Very good. Most of you got that right. Richard is ahead. Excess reserves or reserves of the bank what? Is required to hold, holds beyond what is required, doesn't want to hold, or needs to meet its requirements. I did say this in passing, although very good. Everyone got it right anyway. Excellent. Now Marsh has crept ahead. Question 5, if a bank sells some bonds to someone, do the bank's liabilities increase? Do its assets increase? Do its liabilities decrease? Or do its assets stay the same? You actually looked at this. Okay. Interesting. Remember, if they're selling them, the assets are down by the bonds, but now they have the cash, and the two should be the same. Alexandra C is in front now. And last question. What is a bank run? A sporting event sponsored by a bank? A panic among bank customers? Is it when bank share prices rise? Okay. It's not. It's a panic among bank customers. Very good. It's not a sporting event. All right. Very good. Let's see how we did. Richard is in third. Second is Marsh. And our winner today is Alexandra. All right, Alexandra. So, as a worthy winner, what awful thing would you like to do to me on Snapchat?
Is there a singing, singing one? Yeah, with a microphone.
Like with a microphone. Let's see. Microphone. There seems to be one that turns me into a microphone, but I think that's not quite what you had in mind.
That looks perfect.
Okay, excellent. Well, thanks very much, everyone. I hope that was useful. Take care, and, well, have an enjoyable spring break, and we'll see you on the other side. Bye.